$47,000 sitting in a savings account. That's a number plenty of Australians heading into retirement think is perfectly safe territory. Not too much, not too little. Centrelink won't bat an eyelid, except that assumption has quietly cost some people hundreds of dollars a fortnight in reduced pension payments, and they never saw it coming. If that number made your stomach drop a little, stay with me, because this video is not about panic. It's about showing you the exact thing Centrelink is actually measuring, so you're never caught off guard again. G'day, I'm Paul, and if this is your first time here, welcome. Stick around. Now, here's what I want you to walk away understanding by the end of this. Centrelink is not simply looking at your bank balance, it never has been. It's running your money through a completely different lens, and once you see how that lens works, the whole system becomes a lot less intimidating. A lot of the anxiety people feel around Centrelink comes from watching the wrong number. Today, we fix that. Let's start with the thing most people get wrong, because it's an honest mistake, and it makes complete sense on the surface. You look at your savings account. You see a dollar figure. You think, that's what Centrelink sees too. But that's not how it works. Centrelink looks at your money and asks two separate questions. First, does this count as an asset? Second, does this generate deemed income? Those are different questions, and the answers determine what lands in your pension calculation. Your bank balance is just the starting point. What Centrelink does with that balance is where most people lose the plot. Here's the central idea, and I want you to hold on to this, because everything else flows from it. Centrelink doesn't care what your account is actually earning. They don't ring up your bank, check the interest rate on your savings account, and apply that to your pension. Instead, they apply something called deeming. The government sets two deeming rates, and those rates are applied to your financial assets regardless of what your money is genuinely earning in the real world. As of the time of this video, and please check current figures with Centrelink or a licensed advisor, because these rates do get updated. The lower deeming rate applies to the first portion of your financial assets, and the higher rate applies to anything above that threshold. For a single person, that threshold sits at around $62,600, with a lower rate of around 0.25% applied to assets up to that point, and a higher rate of around 2.25% applied to everything above it. For couples, the thresholds are different. Again, check the current numbers directly with Centrelink, because even a small shift in those rates changes your calculation meaningfully. But here's the thing that should genuinely shift your thinking. It doesn't matter if your savings account is paying 5.5% or 0.8%. Centrelink is not interested in your actual return. They are applying their own assumed income to your financial assets, and that assumed income is what flows through to your pension assessment. Same balance, same account type, but Centrelink's number and your bank's number are almost certainly different. Now, let's tackle the myth head on, because I hear this one constantly, and it genuinely needs to go. The myth goes like this: if I keep my savings under a certain dollar figure, Centrelink won't touch my pension. People will tell you it's 100,000. Others say 50,000. Others quote some number a mate told them at a barbecue in 2019. Here's the truth. There is no magic balance below which Centrelink simply looks the other way. What matters is how your total assessable assets and deemed income stack up against the thresholds inside two separate tests, the assets test and the income test, and your pension is determined by whichever of those two tests produces the lower payment. So focusing on your balance alone as though there's a single safe harbour number is looking at half the map and thinking you know the whole terrain. This is not me trying to make things sound more complicated than they are. It's actually the opposite. Once you understand the two tests and the deeming mechanism, the system becomes predictable. You can run the numbers yourself. You can make decisions with confidence. The complexity shrinks down to a handful of figures that actually matter, and we're going to walk through those in the next section. But before we get there, I want to plant a question in your mind, and this is the re-hook, so stay with me, because this is where it gets genuinely useful. If Centrelink is applying a deemed income rate to your financial assets, regardless of what they're actually earning, what happens when you have money sitting in a low-interest account that Centrelink is treating as though it earns more? And what happens when you move that same money into something that actually earns more, but Centrelink's assessment stays exactly the same? That gap between what Centrelink assumes and what your money actually earns is where smart, simple decisions can make a real difference to your fortnightly payment. I'll show you a worked example in the next section with a character I'll call Margaret, a 68-year-old single woman in regional New South Wales, and we'll look at exactly what a change in how she holds her assets does to her fortnightly pension figure, not in theory, in actual dollars. The goal here is not to have you walk away frustrated at the system, even if some frustration is completely understandable. The goal is to give you 3 or 4 numbers that actually matter, show you where to find them, and leave you in a position where you're making decisions based on how Centrelink actually works, not how people assume it works, because those are 2 very different things, and the gap between them is costing some retirees real money every fortnight. Let's go find those numbers. Right? Let's meet Margaret. Margaret is 68, lives alone in regional New South Wales, and she's been on the age pension for 2 years. She has $180,000 in financial assets, $130,000 sitting in an everyday savings account at her bank, and $50,000 in a term deposit she rolled over without thinking much about it. She's not wealthy by any stretch. She's careful, she's been saving her whole life, and she genuinely believed her money was under the radar. Here's what Centrelink sees when they look at Margaret's situation. They apply the lower deeming rate of around 0.25% to the first $62,600 of her financial assets. That gives them a deemed income figure of roughly $157 per year from that portion. Then they apply the higher rate of around 2.25% to the remaining $117,400. That produces a deemed income figure of roughly $2,642 per year. Total deemed income from her savings, approximately $2,799 per year, or about $107 per fortnight. Now here's the part that surprises people. Margaret's savings account is actually paying 4.8%. In real terms, she's earning close to $8,640 per year on that $130,000 account alone. But Centrelink is not using that number. They're using their own assumed figure, which is considerably lower. In Margaret's case, that's actually working in her favour because her real return is higher than what Centrelink is counting against her. She is earning more than Centrelink thinks she is, and her pension assessment doesn't change because of it. That is the thing most people miss entirely. Your actual interest rate is almost irrelevant to Centrelink's calculation. Deeming is a fixed government assumption applied to the asset, not a reflection of what that asset is genuinely earning. So if you've been stressing about your savings account, paying a good rate, and wondering if it's triggering something, you can breathe. Centrelink isn't watching the rate. They're watching the balance, and then they apply their own rate to it regardless. But here's where it flips. Suppose Margaret decided to withdraw $30,000 and spend it on a holiday, renovations, or gifts to family. Her financial assets drop to $150,000. Her deemed income drops too, and her pension potentially increases. But if she gifted that $30,000 to her children, Centrelink's gifting rules could mean it remains accessible for up to 5 years under the deprivation provisions. The balance drops, the assessment might not, and that is a very expensive misunderstanding to make. So what are the three numbers that actually matter? Here they are. Number 1 is your total assessable financial assets. This is not just your bank balance. It includes savings accounts, term deposits, shares, managed funds, and account-based pensions if you have them, though those have their own rules. Add them up. Get the real number. Most people underestimate this because they forget about accounts they opened years ago or term deposits they haven't looked at in a while. Number 2 is the deeming thresholds and rates that apply to your situation right now. Single or couple, the thresholds differ. The rates change periodically. Don't rely on what someone told you 2 years ago. Check the current figures on the Services Australia website or ask Centrelink directly. This number tells you how much income Centrelink is assumed to attribute to your assets, which feeds directly into the income test. Number 3 is where your pension payment actually sits. Is it being reduced by the assets test or the income test or both? Whichever test produces the lower payment wins. If you don't know which test is currently limiting your pension, you don't know what to fix. That one piece of information changes everything about what action makes sense. Now, before you ring Centrelink or book in with a financial advisor, and I do want you to do both of those things, if your situation is anything like Margaret's, here are 2 things you can do today. First, log into your MyGov account and check your current pension rate and which test is applying. Services Australia shows you this. It takes 10 minutes and it tells you whether it's your assets or your deemed income that's doing the work. That's your starting point. Second, write down every financial asset you hold, including ones you haven't thought about recently. Term deposits, online savings accounts, shares, anything like that. Get the balance on each. Add them up. Compare that total against the current full and part pension asset thresholds for your situation, which again are on the Services Australia website. You'll immediately see where you sit and whether the assets test is even a factor. And just to be clear, because I want to be upfront about this, everything I've shared today is general information. It's not personal financial advice. Everyone's situation is different, and I'd always encourage you to speak with a licensed financial advisor or contact Centrelink directly before making any changes to how you hold your money. The numbers I've used are indicative and based on rates current at the time of recording, right? Let's pull this together. The balance isn't what Centrelink is watching. Not really. They're running your financial assets through a deeming formula and then checking 2 separate tests, the assets test and the income test. The lower result wins. And the gap between what your money actually earns and what Centrelink assumes it earns is something that genuinely intelligent, simple decisions can work with. 3 numbers: total assessable assets, current deeming rates and thresholds. Which test is limiting your payment? Know those 3 things, and the system stops being a mystery. If this helped you make sense of something that's been sitting in the too hard basket, hit subscribe. I put a new video out every week. Plain language, no jargon, just the stuff that actually affects your pension and your pocket. And if you've got a question about your own situation, drop it in the comments. I read them all. I'm Paul, and I'll see you in the next one.